So we could not be happier to have you here. On the week, of course, IMF World Bank meetings, there's a lot going on. So your focus is on inflation, it's on data, it's on Europe. Is there anything to be alarmed about what's happening in Europe economically?
Well, first of all, very nice to be here with you, Francine, and with all of you here. So what, in my position as head of the European Central Bank, what I focus primarily on is prices, price stability, inflation, and how it's evolving over the course of time. And at the moment, we are not totally unhappy with what we see, because it looks very much that inflation is on the right track of disinflation. You know, we come from very high numbers, as high on average for the whole of the euro area as 10.6%. And the latest reading we had for the inflation in September was 1.7. So, you know, those numbers are relatively reassuring. They are only a number, and we're not looking at one data point, as I have said repeatedly. We're looking at a lot of data to make sure that this disinflationary process continues to be well on track. But, you know, we also have to be cautious. And you know, we cannot jump to conclusion that, okay, done deal, we've broken the neck of inflation. No. And I think caution leads us to look at all the data that are coming in, whichever form it takes, whether it's survey indicators, as we had a lot of that in September, or whether they are more model derivated as when we have projection exercises. And we will be looking at that and continue to be data dependent, but of course, cautious and not jumping to conclusions.
So when you look at inflation, could you achieve your target a little bit earlier than expected?
That would be my hope. You know, if our target is 2% medium term, and I'm absolutely confident that we will reach that target sustainably in the course of 2025. Is it going to be early in 2025? Is it going to be very late in 2025? I think it really will be determined by data, by the state of the economy, by energy prices, by the transmission. You know, we look at three components. We look essentially at inflation outlook, we look at underlying inflation, we look at transmission of our monetary policy. And on the basis of that sort of three pillar analysis, we can assess whether we are definitely on track and when.
Do you think it's a little bit sooner? I mean, so we, of course, at Bloomberg look at every single word.
Yeah, no, I know. So I'll be quiet now.
First quarter, second quarter, or is it just too soon to say?
I think it's too soon to say, because I wouldn't be loyal to our principle of data dependency if I was to tell you it's going to be on such time in the course of 25. I think we all, governors of the Governing Council, and I'm sure you will be hearing lots of them in the next few days, because they will be on air very much. I think we are all confident that 25 is the year when we reach our target on a sustainable basis, and with the medium-term caveat that I have mentioned. But we have to be attentive to everything. You know, we have energy prices that are low at the moment relative to where they could be. We have services going slightly down, but not much. We are still at 3.9% in the last reading, and we have to pay attention to domestic inflation. That is the segment of inflation that is proving resistant. And domestic inflation is largely based on services. Services in itself largely labor intensive. And we have to, as I said several times, we have to be very sharp in our analysis of the nexus between wages, profit, and productivity. That three-pillar platform will be very indicative of where services prices, which will inform domestic inflation.
You could have a situation where not all inflation indicators fall at the same time, right? In the next couple of months, would you still feel comfortable if only some of them reach 2%? With the trend going that way?
You know, if you want to have an average of 2% medium term, and you know that, for instance, the inflation of goods at the moment, at least, based on the information we have, is 0.4. By necessity, you will have other components of your inflation measurements which are higher than 2%, because we think in terms of average number based on the proportion of products, services in the inflation basket, if you want to call it that way. So not all elements will have to be at 2%. We will need to have headline inflation at 2%. That's the target that we have set for ourselves. But where you have a point, I think, is we need to be as granular as we can in the analysis of inflation of services, because that is the one that is tricky and resistant. And we have to pay attention to what is sort of structural, what results from latest developments, what those latest developments indicate. Are those elements sort of what we call latecomers? For instance, if you think in terms of insurance generally is, the premiums are renewed on an annual basis. Those are the ones that we call latecomers, because they will increase their prices at the end of the year. We need to do the same analysis with wages. The beauty of Europe is that it is diverse, right? Okay. In some countries, they renew the collective bargaining agreement on an annual basis. So there is a relative regularity in the increases. In other countries, they will renew the collective bargaining agreement every 2 or 3 years. And there is a catch-up element. So we have to really, we have to do that granular analysis, which will inform where it's coming from, how long it's been in the making, what is the catch-up element about it, and how lasting it is for the future. So we need to look at information from the past, which is relatively stable, to see how it informs our assessment of the future. We do all that.
But so if you look at the economic blueprint that we're seeing for the moment in Europe, so inflation is coming down, wages are rising, the economy seems to be holding up, but what's happening with consumers?
I would qualify I agree with you, maybe except on wages, because I think that wages is at a bit of a pivotal moment where, and it goes back to my granular assessment. If you look at compensation per employee, it is beginning to go down a bit. If you look at negotiated wages, depending on whether you include the one-off payment catching up or not, it's also moving in the direction of lower growth than what we have seen. So that leads us to think that this wage increase that could have led to second-round inflation is probably beginning to abate now. But coming back to your consumer point, that's a really interesting European phenomenon. I think our narrative, the narrative that we gave in September, which is the fact that recovery will be driven by consumption, because the real income that households have or that corporates have to invest has improved over the course of time, that still holds. The timing of that is being extended. And the European consumers certainly, in general, do not have the same propensity to consume than the US consumers. You know, it's often said that, oh, as long as the US consumers consume, the economy will do fine. The European consumers are not on the same page of active consumption, I would say. And if I look at Q2, consumption has actually gone down a bit, although real income, disposable income, had increased. And savings in Q2 again had increased. So it's as if, on average, the European consumer was sitting there looking at his real income increasing, looking at the world out there, looking at the war at the doorstep of Europe, looking at developments in the Middle East, looking at the political uncertainty around and thinking, well, I might be better off saving a bit more. And who knows, I might cut a good deal with my bank because the banks are still offering not generous, but possibly attractive rates for time deposits rather than consume.
Do interest rate cuts help with that? Should they actually, or is it transmission mechanism taking longer than expected?
I don't think so. I think gradually reduced interest rates are being transmitted, and our monetary policy is traveling to financing, to the activity, and ultimately to inflation. So it should encourage spending, whether by way of consumption or investment. But on investment, we're not seeing much at the moment either.
Are you expecting it to pick up, or are there particularly weak countries that give you worries?
Well, there are countries that currently are not performing spectacularly.
When are you expecting them to pick up again?
Well, I think a revision of the business model and a collective endeavor to support the economy would be helpful, including, public spending.
But there's no real sign of that coming in some of these countries.
Well, nécessité fait loi. I don't know how you translate that.
Necessity usually leads to something, which is the overarching point. Madame Lagarde, when you look at monetary policy, so the markets really expect quite a lot of incremental interest rate cuts until April. Are they right?
It's their analysis. As I said, disinflation well on track. Have we broken the neck of inflation? Not yet. Should we jump to conclusion, or should we not be a bit cautious? And as data dependent as we have committed to be, I think is our determination. Now, markets have their own way of looking at things, and they're playing with other people's money, and the more they make, the better, I guess.
So
my objective is price stability.
So markets could derail a bit of that if they misprice things. Do you just ignore markets, or do you try and guide them to something?
No, we don't ignore anyone. We look at what colleagues do around the world, what impact it has on us. By necessity, we have to factor into our models what markets anticipate in terms of rate curve, but it's not to say that we are market dependent. Far from it. But it's a component that we take into account. Yeah.
What would it take you to do 50 basis point cuts?
I don't want to speculate. I think for me, the direction of travel is clear, and what we have done, starting in June, is I think the sensible approach, and one that should be continued with that caution element about it, not jumping to the conclusion that, because we've done 25, we'll do 25 in each and every time. No. Or because we think that it's going to be down or up or this, we'll do 50. I think that's not called for, given how we are trying to really be solid in our analysis and be both data dependent, but also applying judgment and trying to look forward. And we need to scrutinize and be as granular as we can, because we are getting closer to the point where hopefully the economic situation will be in the right equilibrium. But to jump to conclusions and you will have people the whole week saying, it should be 50, it should be 25. No. Direction of travel, clear. Pace to be determined on the basis of backward and forward-looking element, using the three criteria and applying judgment. I think that's how I see it. But it's a collective endeavor in Europe. I'm lucky to have plenty of very smart governors around the table, and my executive board members. Everybody has a view.
Everybody does have a view.
Yeah.
When is the right time to start thinking about being less accommodative? I don't know how often you get asked about the neutral rate, or whether it just gets...
Very often and invariably I say, I don't know. Because it's not an elusive concept, but it's one that is, first of all, pretty complicated to articulate, and that is based on multiple factors, including productivity, aging, the impact of climate change, and all the rest of it. So if you were to ask me today, where is it? The honest answer is I don't know. I think fair to say, and credit to the research of the ECB, which is not the line adopted by either myself, the Executive Board, or the Governing Council, but I think their conclusion is that it's going to be lower than where it is today, and it's probably going to be higher than where it was anticipated to have been prior to COVID. So anywhere in between.
That's a big range.
I know it's a big range, but it's you know, it's not like a mirage, but it's something that you can see, perceive, and identify the closer you are to that element, because it's an equilibrium where you have the perfect economic conditions, employment at potential, growth at potential. But we are not there for sure, and we are still restrictive, and will continue to be for as long as it's needed to get to that point.
I mean, I know that your mandate is only inflation, but we had the Draghi report, of course, on competitiveness. It was pretty alarming.
Draghi is former president,
so he comes into your fold. I mean, he was pretty alarming, actually, in what Europe needs.
No, I think that he was alarming in his diagnosis of where Europe is at, and I think I said it was alarming and fair or just. I forgot what I used. Because I think that he has conducted, in his position as retired president of the ECB, retired governor of the Banca d'Italia, retired prime minister of Italy, he had this sort of paramount vision, holistic vision, if you will, of how Europe functions, what's missing, where are the gaps. And he had, a great team of economists and other experts who helped him and fielded his considerations and thinking, which is why I think his diagnosis is severe but just. His suggestions for the future in terms of what needs to change, what needs to be done, what reforms must take place, this is not alarming, or unless you say alarming because he's setting the alarm bell saying, now is the time to get on with it, please. And he's better equipped than anybody else to do that because he's been there, he's done it, he's seen the procrastination in play in those European leaders' council meetings. And I think I really like his report. I don't agree with everything that he says. And I think that our job now and the job of the Commission and the job of the European leaders is to filter out what can be done expeditiously without bumping into resistance and obstacles and territorial wars and turf discussions, to move the needle and to make sure that both on productivity, where there's a huge big lag, on a better energy sovereignty, on the fluidity of labor factor and capital, there is real progress. For my money, in my position, I would want those three components to really be addressed, because it would make a difference for the fight that we have against inflation.
I mean, there are a couple of, I guess, concrete points, right? There's a huge cross-border possible banking merger that could or couldn't happen. There's, he mentioned, the joint issuance of EU bonds. What would make
what he said on the latter point, because it's a controversial one.
Yes.
Let's face it, the issuance of European bonds, we did it once with COVID, and you have a whole bunch of European leaders who say, oh, it was a one-shot deal, never again. So it's a highly controversial element of his report, which is why it's being picked up by media and others. He himself said at the Bruegel Institute, which is pretty thorough and deep into these matters, he said, you can read my report, take my report, move on with it, and take ownership without that chapter. Forget about the debt issuance. If it's going to be a battle between the Nordic and the Southeast, and forget about that. But do the rest, and I think he's right.
Would you be in favor of bank consolidation to almost signal that actually Europe means business?
Two particular. I think productivity is the key battle, but it's not directly related to what we do. What is directly related to what we do, because of monetary policy transmission, notably, and because of the financial stability without which price stability will be an illusion, is number one, capital market union, and banking union. Banking union, you can think of three pillars. Two have been built, and the third one is missing. So that's what, the EDIS, which is the European Deposit Insurance Scheme, does not exist yet. So every country is on its own, and that needs to be addressed. My colleague Joachim Nagel actually this morning committed a nice op-ed on that, and I'm delighted that he did. And capital market union, we have in some areas, post-market infrastructure, we have 27 different backbone. That doesn't work. Or it does. No, I shouldn't say it. It works, but it is suboptimal by a long way. And one of the strengths of the US market has to do with the capital market that is vibrant, deep, liquid, and I think much more easily accessible than it is in Europe.
Is I guess the window for Europe to get its act together narrowing? I mean, we also sit, if you're European, between the US and China. The IMF also.
You could argue that it's a strategic place to be in.
As long as?
As long as it is solid and strong enough to stand with its own sovereignty and its ability to keep the savings at home. That's one example. There is so much European savings that travel the world because they don't have an instrument or a market in which to invest.
But what are you optimistic about going forward? I know there's, we talk a lot about tariffs, we talk a lot about trade also being rebuilt now because of geopolitics instead of economic advantage. That must make it harder for Europe.
Well, first of all, there is a lot of trade that takes place within Europe. It's not necessarily well accounted for, but there is a lot of goods and services movement within Europe that can be improved significantly. And you need to look at the Letta report in addition to the Draghi report. And Enrico Letta, former prime minister as well, makes the case for better European integration. Remove some of the obstacles, do away with some of these multiple licenses to operate, the prior authorization here, prior authorization there, and have a real integrated deep market, one of the largest in the world. But we keep procrastinating about little boundaries everywhere. So that integration will increase, in my view, the trade that is within Europe. And I think it will also encourage investment in Europe because investors look at the general terms, the tax regime, but they look first and foremost, what is the market? Where will I sell? Is there a deep and wide market? What scale can I get as a result of my investment? So I think that a lot is in our hands. I don't like restrictions to trade. I'm a former trade secretary for my country in France, and I just know how much trade can bring in terms of competition, in terms of added innovation, in terms of elasticity. I think trade is helpful, but the trade conditions have to be fair. They cannot be constantly subsidized in a very opaque and unfair way.
I was going to ask you, so we recently had an interview with a US presidential candidate who said tariffs was his favorite word. I imagine because of also your background, former IMF, former trade minister, this is not your favorite word. What is your favorite word?
I think fair trade is a key boost for growth, for employment, for innovation, for productivity. And I would say that it's something that we should not throw away because in any period of time where this country, the United States, has thrived, were periods of trade, not periods of I'm going to retire behind my boundaries and play at home. No.
I mean, there was a big UK media outlet that called the US economy the greatest economy on earth right now. I mean, would you agree with that? Where does it leave the rest of the world?
I think it depends where you are on the social ladder. I think you have to go further than look at the sort of aggregate numbers or the average numbers. It depends on where you are on that ladder. If you are at the bottom of the ladder, if you have small job, not much by way of income, I'm not sure that you think of, being in the first and best economy in the world. So everything needs to be considered. But it's a case that the US, for instance, has very high productivity, has a very vibrant tech sector, and has had it for a long time, so it has capitalized on it. since the beginning of the 21st century, and that there is a lot of catch-up taking place at the moment. But I think you cannot look at that in isolation. You have to look also at the people. And I think if you look at the Gini coefficient, which is probably not the best way to measure inequality, the US is not doing so well from that perspective. So it's also a question of spreading and distribution so that all people can benefit. Sorry, I'm being political now, forget it.
But do you worry about central banks being political or being dragged into the political sphere?
No, because I think there is a huge resistance to that in the decisions that we make, despite what is being suspected here or there in any place in the world. And I think for those central banks which have the privilege of independence, either by virtue of the treaties or the tradition, it's critically important to hang on to it and to defend it, because the credibility of an institution like a central bank really is a factor of how independent it is vis-a-vis the politics. And it's precious. It's very precious.
But do you think that you'll come under attack more? Not you personally, but just central banks. Donald Trump said, Jay Powell had the easiest job because it's a flip of a coin every month.
He should come and visit us. And I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month. And they are extremely conscientious and determined to really do the best job they can to deliver the right monetary policy and secure what is our common good, which is our currency. So we defend the euro and we fight for the euro, just as the Fed defends the dollar, fights for the dollar, I'm sure. I don't want to speak for Jay Powell, but I'm sure that's how he sees his job.
We're just kicking off IMF World Bank Week. What are you most looking forward to?
Oh, seeing my friends. That's the first one. And I'm not saying that just jokingly. I think that there is huge value in meeting people who are equally concerned, who have the common good at heart, and who will, inform each other of where they see things, what obstacles there are, how we can better cooperate. And it's some people say, oh, it's a big talking shop. Yeah, but it's better to chat than to war, as Churchill would have said. And cooperation, with the caveats, with the difficulties, with the temptation of protectionism and all the rest of it, but cooperation is at the very center of keeping some sanity in this world.
I mean, the world is so complex. If there was only one thing that you would like to figure out this week, what would it be?
Peace.
One question.
Peace. If you ask me one word, that's the one that I would use. Because when I was IMF managing director, I have seen the destruction and the disaster that war can bring about. And I have seen countries that had gone through programs that were just graduating from programs, falling back into poverty, into economic disaster because of war. So yeah, the world as it is, if there was one thing that I could achieve because I have a magic stick, it would be peace.
Do economics come into play though? It feels different this time.
Well, the wars that we have out there, and it's not just Ukraine and the Middle East, there are many other theaters of operation, like Sudan, for instance, not much talked about, that bring uncertainty and that undermine the confidence that people have. We were talking about the European consumer being uncertain. I think, the uncertainty is fueled by the lack of confidence. What will the future be like with those wars on the horizon and the political uncertainty about addressing them and resolving them?
Christine Lagarde, thank you so much for your time today, and we wish you a successful IMF week. Thank you.
And to you too. Thank you.
Thank you so much. If I could ask everyone just to stay seated 1 second. So I know you have a meeting to do, so I'll escort you out.